Now, our next guest, Tim Schroeders from Pengana Capital, joins us now from Melbourne. Tim, how do you see this new tax affecting the miners and in particular mining profits?
Thanks, Heidi. Look, I think it's never a good thing to have such a huge impost put on any industry, and this 40% resource rent tax is no exception. But having said that, the way in which it's structured, with the ability to, in effect, have accelerated depreciation of capital and deductibility of exploration and future capital in terms of capital expenditure for maintaining the operations, in effect, this is probably not that bad in terms of what I personally was envisaging a week or so ago. So it's an impost that the industry will have to deal with, but it's far from a disaster.
Can they afford it?
Anyone who gets asked whether they can afford it will say no, but the degree of profitability within particularly the major miners is such that it's very robust, margins are very high, and it will impinge profit, but it won't go as far as taking the companies from profitability to loss, at least at the major end. In some of the more subjective, less traditional industries, if we look at things like coal seam gas, for instance, coal seam gas to LNG, with a lot of companies looking at proposed projects in Queensland at this stage, it could have a very vast company-changing impact in terms of now bringing anticipated rate of return to below what would be acceptable for some investors.
So will this curb investment? Of course, these mining companies, if they decide to develop a mine site or a project, they have to make multi-billion-dollar investment decisions. Are we going to see those starting to stall, or like you said before, could those concessions for CapEx and the like actually mean the reverse?
I don't think it's a net positive, so net, this is a negative that the mining companies will have to contend with. But having said that, the 40% headline rate is nowhere near as severe in terms of its flow-through impact to the bottom line of these companies, which, on the work we've done so far, given it's very preliminary, could impact earnings around 10% for most companies and valuations around the same, possibly less than 10%.
Tim, as Haslinda in Singapore, could this tax derail M&A activities in the mining sector?
I think that's a great question, Haslinda, and the work that we've done is it definitely increases the hurdle for prospective buyers in the resource space in Australia, and as such I think any probability of mining takeovers proceeding has lessened as a result of what was released yesterday by the Australian government.
That's a report by Citigroup saying that the tax could also force BHP and Rio to change the terms of their iron ore joint venture. What's your thought on that?
Well, I think there's undoubtedly an imperative by both parties to see the joint venture proceed. But having said that, is there a more tax-effective way, taking into consideration the changes that were announced yesterday? And I think both BHP and Rio Tinto will be working feverishly to look at any possible restructure of that joint venture. Whilst being committed to it in principle, there may be a more tax-effective way of pursuing that, bearing in mind that there's a huge carrot of over $10 billion US in anticipated cost savings as a result should the merger proceed.
And you recently cut the net long position of your fund, which returned 22% in the past 6 months. That's in anticipation of the tax decision. Can you quantify the likely impact this tax will have on your investment?
It's definitely a concern, and whilst I think the devil is in the detail, and that will emerge as people run their numbers over the next few days, I think there's always the likelihood of a knee-jerk reaction. We're seeing very much a case in point today on the Australian market, where the metals and mining index within the Australian market was down 3.5% this morning, and a lot of the stocks did cop a fairly savage sell-off as people focused on the 40% alone without drilling down into the details and the impact for these companies.
What are you doing? Will you be cutting your exposure to your top 5 holdings, which include BHP, Rio, Vale, Xstrata?
No, in fact, I think this is going to be an excellent buying opportunity, Haslinda, and this morning we've been very judiciously and cautiously increasing our holdings in companies such as Rio Tinto.
But you've also said before that the outlook for companies like Rio is pretty cloudy.
It is, but having said that, the impact of these changes to our valuation is probably less than 10%, and our valuation, even taking into consideration the recent changes, we can still get a value for Rio Tinto, for example, in excess of $100 Australian a share.
Tim, before we let you go, your thoughts on where we are in this commodity cycle? I mean, what are we like to see commodities do in the next 6 to 12 months?
I think commodity prices at the moment are at very healthy levels, and it's going to be difficult to see a next leg up from here. And with increasing, activity by Chinese authorities in trying to curb speculative activity in their economy, we may very well see a softening of activity, albeit a moderation of 1 or 2% from very high levels. And that might be enough that we see commodity prices move sideways to moderately down over the next 6 months, but I don't see a collapse or an end to the cycle at this stage.
Gold the way to go, Tim?
Gold looks to be a fairly crowded trade at the moment, where people, for a number of reasons, have migrated to increase their gold exposure, and I'm sort of at these levels, given we're up within $50 of the all-time high. I'm just a bit cautious of going to such a crowded trade, and for instance, if we see a resolution that the market likes with respect to Greece, we could see a fairly dramatic sell-off in gold short term.
Okay.